Good afternoon, traders and investors. Will back here with another one, and welcome back to another edition of our subscriber request videos, where we go through the comment section of all my videos over the last 2 weeks and take all of the tickers that you guys wanted me to look at. We'll be spending about 2-3 minutes per ticker going over a very brief overview of the company's fundamentals, the company's technicals, and whether or not I deem it to be a decent opportunity for either a swing trade or a long-term investment. Now, in today's video, guys, we have a lot of requests, so thank you very much for providing all of them. We're going to go through about 15 different companies today, and I always appreciate your guys' shout outs in terms of tickers, right? Because of course I know a ton of stocks, but I do not know all of them. So thanks very much for providing some potential insights into some trade ideas or some long-term portfolio ideas. Now, before we get started, guys, I wanted to take a brief look at first as to what I look at for a long-term investment. Now, because most of you didn't specify whether or not it's going to be a long-term investment or a short-term swing trade, I'll give my outlooks on both, of course. But if you're looking for a long-term company to invest in, here are the criteria that I look for in these types of companies that I add to my long-term portfolio that I'm looking to keep over the next 5, 10, 15, and even 20 years. So here's the list right here, guys. We're not going to go through each one, but the one that I want to stress most importantly here is the fact that the company has a competitive advantage in its industry. If you're looking for a long-term investment, guys, you have to be able to say what a company's competitive advantage is, what is their moat. If you cannot clearly determine what the company's moat is, it may not be the best choice for a long-term investment, so keep that in mind. Thereafter, guys, we want to see consistently increasing revenue and EPS and consistently increasing free cash flow numbers. Those are very important, guys, because never forget, a stock's price is a reflection of future earnings and future cash flows. So we want both of these two things to go up. I'll just take the poster child of a company that's doing both of those two things. Take a look at Microsoft right here. Microsoft's EPS growth curve, super smooth, super consistent, super predictable. Revenue curve down here as well. Consistent and predictable, right? That is why Microsoft is one of the best companies in the world and why its share price goes up and up and up more so than not, because it is such a predictable company with very, very high competitive advantages in its industry as well. Take a look at free cash flow. You can see that every single year, the middle column in blue right here, for the most part, is growing, and this is the last 5 years. So that is why, or that is what I look for in a long-term company for a long-term portfolio. And obviously you want to find high return on capital employed, high return on invested capital. Those are internal metrics of when a company receives cash, either through debt or through equity raises, stuff like that, or through operations. How well is it able to utilize every single dollar that it receives? Usually you want to look for ratios above 15%, and you can just Google these types of things, right? If you want to know what it is for a company, just Google Microsoft ROCE or Microsoft ROIC. If you see both numbers over 15%, usually an extremely high quality investment. You want to see also relatively low debt, guys. That is very, very logical, right? You don't want a company to be too plagued with debt, because if it is, all the free cash flow and all the revenue that they generate is going to be used to service the debt and possibly not do share buybacks or pay dividends, which are direct returns to the shareholders. And lastly, you want to find these high quality companies such as Microsoft at huge support levels, daily, weekly, and monthly. You might remember a few short weeks ago at this point, right? Visa was coming into one of those huge support level on the weekly and monthly timeframes. Extremely high quality company, extremely predictable, growing revenue, growing EPS, growing free cash flow. When it comes down, the breakout retest of the prior all-time highs, great technical entry for a great company, and the rest is history. We absolutely crushed this one on the channel publicly. So that is pretty much everything I look for in a company, guys. Now let's start off the subscriber requests, and we're going to start it off with Jay here asking, can I please review WBA and Sound? Well, just to be fair for everybody, guys, when you guys post multiple tickers, I'll always be taking the first one. So let's move on to Walgreens Boots. And we know that this company has been plagued by many, many, many different things, right? They have a big problem with profit margins eroding. Amazon is taking a lot of their pharmaceutical business as well. And we also note a secular trend away from purchasing odds and ends at pharmacies. Obviously, we know that pharmacies have two main sources of income, right? Number one, the pharmaceutical business, and number two, everything else that they sell in the store, right? It's kind of like a mini grocery store in certain aspects like that. Now, there's a secular trend to move away from this. A lot more people are deciding to get those small items either at grocery stores or at big box retailers like Walmart or Costco, or maybe even online like Amazon. So that is the part of the business that's really suffering right now, guys. Take a look at Walgreens net margins. Very, very thin net margins, guys. They are not doing too well. Take a look at the debt load right here. Crazy amounts of debt in relation to the free cash flow that they bring in. Free cash flow is almost non-existent for this company, unfortunately. So this company is being burdened by its debt. Take a look at your EPS expansion curve. Well, we do not have expansion. We have EPS declines. Not the best for the company. Take a look at the revenue expansion curve. Revenue is largely going to be somewhat flat. If anything, it's growing at about 3% per year, 4% per year. So not the best, right? Now they do pay a dividend, but just be careful of a high dividend, guys. Sometimes it's indicative of a value trap. Take a look right here. Walgreens Boots pays out 57% of all their free cash flow in terms of their dividend, right? So it stands to argue if they're paying out almost 60% of all their free cash flow, what exactly are they reinvesting in the business, and how are they going to grow the business to get out of the current landscape that they're in right now, right? So Walgreens Boots, an extremely challenging company, as you can see as well. Most analyst price targets are either in line with the share price, a few people above, but everybody has it either as a hold or possibly a sell rating as well. So Walgreens Boots, there is some real bankruptcy risk right now, guys, for this company, right? That being said, the technicals right now are absolutely crushed. So if you believe in Walgreens Boots' ability to turn around the business and get out of the hole that they're in right now, you know, sentiment around the brand is at all-time lows. Technicals, monthly oversold, everything is oversold, massive downtrends, weekly oversold as well, right? So it stands to argue if you did want to take a recovery position in Walgreens Boots, probably now would be the time, but be extremely cautious with this one, guys. The bankruptcy risk is very real. Their debt load is a very real thing as well. And we do have secular declines in that whole grocery or miscellaneous items aspect of the business, right? So just keep a watch on this one, guys. If I had to take this trade myself, I would be going extremely light, and I would be using money that I'm 100% willing to lose. And those are just my thoughts on Walgreens Boots. Moving on to Nathan right now. Can we get your thoughts on DVN? I'm looking for a leap call swing trade for this stock. So Devon Energy. So we know, of course, guys, that energy has been a very popular trade in the last 2 weeks, but arguably not for the right reasons. The reason this trade has been popular, of course, is because of the geopolitical tensions in the Middle East, which is contributing to rising oil prices. But be very careful with oil stocks, guys. There is far too many macro points that can come in and offset this trade. OPEC is one. U.S. oil production is another. What BRICS is doing is a third one. Geopolitical conflicts is a fourth one, right? There is so many external factors for the price of a barrel of oil, and that obviously impacts all of these companies' ability to have consistent returns. Take a look right here, guys. Well, their net profit margins, in line with most oil companies, are usually quite good, between 15 and 20%. But here is my problem with most oil companies and why I do not invest in them for the long term. Very inconsistent business model. It's highly dependent on the price of a barrel of oil. Some years are good, some years are bad, and profits are reflected accordingly. Revenue as well. Very inconsistent and extremely choppy, extremely difficult to predict unless you have a crystal ball for the price of oil and are able to predict how all of those other macro events are going to impact the barrel in the short term. Now, in terms of the fall seasonality, guys, fall is usually the worst period of the entire year to invest in oil, just because we're coming off the summer highs when everybody is traveling, using oil a lot more than they normally would in the beginning of the fall and into winter as well. So you have a little bit of a drop off in global demand in the fall, and that usually resumes by January and February when we kick off the winter demand for oil for heating solutions for a lot of parts of the world which experience the winter climates, right? That being said, the forecasts for the stock are all currently above, which is mostly the case, right? This is not just the case for Devon Energy, as a matter of fact. If you want me to bring up the forecast, this is Devon Energy, this is Oxy Petroleum, right? This is CVX. Look at the analyst expectations. This is ExxonMobil, And the list goes on. For the most part, most analysts are either holding or have a bullish lean on oil. Why? Because the companies have kind of been depressed for the last 2 years, and their charts all look the same, right? Since 2022, no new highs. And that's the same for every single oil company out there, except for Exxon, which is setting a new all-time high right now. But for the most part, every single one of these oil companies has been stuck in a long-term range for the past 2 years, guys. So Devon Energy is exactly the same. I do not think that this company is any alpha, meaning I do not think that it's going to outperform the sector for XYZ reason, guys. It's largely going to be a sector perform right now. So in that case, it depends why you want to invest in this company for the first place. And I'll remind you, a lot of these oil companies, even though they do pay decent dividends, they spend a ton of money in capital expenditures for new venture explorations. They bring in a ton of free cash flow. This is true, but it obviously depends on the price of the barrel of oil. But usually they do have a lot of debt and they have an unpredictable nature. So it all depends on why you're investing in this company, right? If you're investing for a leap call swing trade in the stock, well, it's going to be very hard to pick out whether or not Devon's going to outperform its sector peers. As you can see, it doesn't have a very good history of outperforming this sector as a whole, right? This is CVX, one of your market leaders, and this is the XLE ETF as a whole. As you can see, the XLE Energy, which is mostly comprised of oil stocks, that is at the all-time highs, and Devon is not. So Devon is a underperformer in relation to the best companies and even in relation to the index. So personally, this is not investment advice for you, but this would not be my first pick. If I'm looking to make a play on energy stocks as a whole, I would just go with the ETF. You remove company-specific risk, and for the most part, the leap call options on this one could be possibly a better proposition just because you have that diversification, right? If you're expecting the entire industry to go up, well, I would go with the entire industry and not so much a specific company, unless you have certain information about the stock that most investors are not looking at attentively right now, and you think there's a price discrepancy, right? So those are my thoughts on Devon and my thought for a leap call option swing trade. Myself personally, I would have a more of a bias towards going for the entire industry and not being held down by one stock specifically in terms of the performance. But all of this relies upon you, right? It depends on whether or not your thesis is for the oil sector as a whole, or whether it's for Devon as a whole. But Devon is known as a underperformer towards the sector in the last 15 years. Moving on to Ant for company number 3. So, hey, Will, if you can fit this last minute request, we'd love to hear your thoughts on KMI. Looking at this one for potential earnings play or possible swing trade. It's been on rails for months, and if evaluation looks good, this might be a decent add after a pullback. So another one, guys. Another one of these oil companies, right? And here's the thing about Kinder Morgan, right? So we'll pull this up right away. I'll give you guys the actual US oil and gas industry, the actual forward price to earnings ratio for the sector. It is about a 13.5. Most companies are in or around an 11 to 14 PE ratio. Kinder Morgan right now is sitting at a 21 trailing and about a 21 forward PE ratio as well. As we can see right here, this one has severely underperformed some sector peers and the industry as a whole, and has been on an absolute tear recently. Weekly overbought condition or monthly overbought conditions right now. Weekly RSI is at 82. This is not Nvidia. This is for an oil company. I would be very hesitant to take some trades up here, especially after this booming run. You would have already had to either been in and holding, but taking a position here, in my humble opinion, is extremely risky, right? And that's just for a swing trade, but similar to the rest of the oil companies, they make very decent net margins. They have a ton of debt, not so much free cash flow for this company because they spend a lot of it for exploring new projects, right? Some of which will be profitable, some of which not. EPS expansion is good, but then again, guys, right? They're not expanding EPS that fast. So if I were to do a PEG ratio on this one, it would not look good, right? It would probably be above a 2 PEG. Free cash flow yield would be decent though, and very inconsistent revenue. So they're improving the bottom line, not improving revenues a ton. So it just leads me to believe, guys, that they're bolstering EPS here by buying back shares, not so much through the organic growth of the revenue curve for the company. And all analysts mostly agree with me as well. Most of them are either holding or have slight price targets under. Very few people are above, and they're only at 27. So this one for me would be a pass, but obviously it is your account. You're free to do what you want. Once again, it all relies on whether or not you like this company. If you have some specific information that the company is maybe not, or investors are maybe not listening to right now, or maybe the market is discounting for XYZ reason. But KMI, a little bit too expensive for me at the current valuation. And as I was responding to Nathan, if I had to make a play just for the oil sector as a whole, I would probably be using the ETF using XLE, because you're not beholden to one company specific risk. Moving on to Dominic. So thanks very much, Ant. Moving on to Dominic. Thank you. Wondering your thoughts on CLS. I have a small position, seems to be overbought now, but seems to have a lot of momentum. Sure, let's take a look at CLS. So I looked at CLS a few months back, and this one has been on an absolute tear, right? Only because of the NVIDIA effect, because their products cater to data centers and you have the data center ramp. Other than that, the company was doing absolutely nothing prior to this, right? So that line of revenue is really about 70% of their business right now in terms of expanding. They do something with internet switches, Ethernet switches and stuff like that for data centers. My concerns with CLS, right? So Dominic has let us know that he is currently in. He has a small position, so I assume this is for a swing trade and not for a long-term investment. The long-term investment, guys, this wouldn't be for me. Look at the net income margins. Even with an absolute monster rally, because one aspect of their business is doing very, very well, their net margins are very, very bad. Talking about only 4%, up from about 2.86%. And if I bring this up too, take a look at their net margins over the last 10, 15 years. Barely any expansion on gross, barely any expansion on operating, and now net margins is getting a good bump. But you can see the trailing history, guys, not that predictable of a company. And I do not like when a company has razor thin margins coming into a sector that's very, very hot right now, because they may be doing well with their products, but new competitors are going to be entering this infrastructure ramp for data centers, guys, and it's going to drive the prices of these items down. We know when more supply enters, well, that's what happens to prices, right? That being said, EPS curve is on a nice upswing here over the next 3 years for the data center ramp, but has been absolutely underperforming over the last, let's say, 6-7 years. Revenue is largely the same. If it wasn't for the data center ramp, this company would probably still be trading back down here around $13 to $15. So this one, not a long-term investment for me because of those reasons, because of the too thin margins and the unpredictable nature of this business. They obviously were not able to grow the business on their own without this new industry that's burgeoning right here. So long-term investment for me, probably not. That being said, for a swing trade, I mean, we're coming into the territory right now where the valuations are getting roughly in line, right? There's not that much upside, and even analysts expect the same. That being said, the valuations right now are cheap, but they may be cheap for a reason, guys. They may not want to let this one expand too much because of the concerns that I just outlaid prior. Revenue growth, 9% per year, decent. EPS growth for the next at least 3 years. Beyond that is anybody's guess, right? So the valuation, 17 PE, PEG ratio, a 0.92, which is otherwise very good, but I'm somewhat skeptical, guys, of this one's ability to really garner a higher valuation from Wall Street, because it may just kind of be a one-trick pony for now. That being said, in terms of a swing trade, I mean, we are breaking above. The weekly looks good. We got the weekly uptrend back. Swing trade entries would have been here, guys. Up here, I can't really be buying. We just have no entry levels for confirmation. But for a swing trade, I mean, this would be one where if I was up a lot from down here, I would probably start trimming the position, and possibly leave a little bit to run, because as Dominic was saying, right, we are in heavily overbought monthly conditions. The weekly is looking good for a MACD cross, so maybe one last push into the $70 range with continued bullishness in the data center narrative right now. But this is definitely one where I would probably start scaling back on any prior entries that I had and just take the profits, right? Nothing ever wrong with scaling out and taking the profits, especially when we're working with daily overbought and monthly overbought conditions as well. So hopefully that makes sense, Dominic. Thanks very much for bringing back up CLS. Haven't looked at it in about a month or two. Now, taking a look at Jeff's comment right here, could you give an analysis on HMR? They're working on a patented laser silica purification procedure that was recently proven that it works by UC Davis. They also have programming verticals, solar HQ silica battery improvement technology, and other things in the works. I'm curious what you think. Thanks. So thanks very much, Jeff, and thanks for including everything that the company is trying to work towards. Really appreciate that. So let's have a look at HomeRun, guys. Even I did not know about this company, right? Very, very, very small company to speak of. So this is a small cap stock pretty much. Market cap right now is only about $74 million, and they are in the exploration phase, or rather the development phase of the company right now. As you can see, no revenue to speak of because they're currently in the researching phase. So a lot of this market cap is derived by private placements in equity by institutions or private players. So that is where you're getting the price support right now. In terms of what they do, well, you can take a look down here, guys. They do all of pretty much what Jeff has so eloquently said, but also, right, we want to know where they are in the process of their ramp, right? So phase one, HPQ silica supply, they want to identify and secure a reliable source of silica right here. And that has pretty much been done already. They've mapped out a few locations, at least from what I've found. And now comes phase two, the infrastructure and logistics business. Now, obviously, guys, when you're in the business of manufacturing basic materials for different various industries, right? Whether it's the silica glass that they're trying to develop, they obviously have new patents. They're trying to do stuff for batteries as well. It's going to require a lot of infrastructure build out, not only for obtaining the mineral resources, but then also to process the resources. And then it's a question of scaling and vertical integration. So this one, guys, is a very long-term play. In my humble opinion, this one is probably still, right, 2, 3, 4, 5 years out. And that's just something sometimes that you have to endure with these small cap plays when you're extremely early, right? Now, they've been trying to do this. I mean, the company has been public since 2013, and now we're getting a ramp because we have the whole clean energy, clean materials narrative that's been quite popular since the later part of last January, right? January 2023. So this one, very small market cap, but the way I would get into this one, guys, it has to be a long-term investment. Obviously, there's some swing trades that are possible. You usually look for the retests of prior levels, right? So you get the breakout right here, breakout again, retest of the prior support range. You take an entry and you kind of go for the long bias trade right there. This is on the monthly time frame, right? Not so much on the shorter time frames. So at this current time, right, you have the 12 EMA as support, but I would maybe be targeting the slightly under $1 range for possible entries. If you are looking for the best possible attempt at some swing trade opportunities, we know it's a weekly downtrend right now, so I'm going to be looking to past prior support levels to kind of support us. If it's for a long-term investment, guys, well, if you have a thesis, and speaking to Jeff as well, if you have a long-term thesis, you understand the business very well, you're an expert in the space, and you think they have a competitive advantage and some patents that can really bring them an edge in the industry, well, then you have to give the necessary time for the thesis to play out. We know that they're only on phase one and arguably a little bit of phase two right now, but all of this process, guys, especially for a basic materials company, takes a very long time. I'd like to see 2-3 years, but probably the next 3 to 4 years before we see any, progress whatsoever. So just understand the risks of investing in something like this. It's probably going to be a long duration hold, and you never actually have confirmation that the business is going to get up and be able to scale properly, right? So this one would once again be an investment that if you are an expert in the industry and you feel you have an edge, no problem. That's perfect. That's your own thesis. But just understand that it's a more long-term play, and you have to let the long-term play into the thesis, right? 74 million for a market cap, very cheap. If you're looking for eventual valuation, 700 million, and then the eventual 7 billion, which would be your 100x, right? 740 billion would be your 10x, 7.5 billion would be the 100x. You need to kind of get in now and then just let them work over time and let the thesis kind of play out, right? So that's how I view a play like that in the small cap industry. Now, moving on to Matthew, please review Wynn. Yes, of course, Matthew, no problem at all. So let's review Wynn together. And before I do, let me get a quick sip of coffee. And let's get into it. So Wynn is actually one of my favorite hotels to stay at whenever I go to Vegas. But keep in mind, Wynn, guys, only has 4 properties. So even though I like the hotel chain, I like how it's run, it's kind of beholden to the fact that it only has 4 locations, 1 in Vegas, 1 in Boston, and 2 in Macau, which is known as the Las Vegas of Asia, right? So that being said, Wynn has been really depressed over the last 2-3 years. That's because of the exposure to their Chinese properties. I've been to the one in Vegas, as a matter of fact, in June, and they were booming. Haven't been to the one in Boston ever, so I couldn't give you any information from myself personally, and I have not visited the ones in Macau. That being said, they have been largely held back by the China trade, and you will notice that they only started popping after the China stimulus trade became a thing just a few short weeks ago, right? I loved Wynn, guys. I was advocating this one on the channel for a very long time in this range of support back here. roughly the lower $70 range. I like the company's valuation down there. It was fairly cheap, but just keep in mind, guys, that this one is not as solid as your larger hotel chains such as Hilton and Marriott, right? Now, this is not a byproduct of the fact that Hilton and Marriott have more hotels. It's a byproduct of the different business model that they run, right? So take a look right here. Marriott profit margins are about 12% right here. Take a look at Hilton as well. Hilton profit margins, for the most part, in a good economy, are about 14%. And take a look at Wynn. You'll notice a stark contrast, right? Only 6%. Why? Because Wynn owns its own hotels. Marriott and Hilton run a franchise model whereby they do not own 95% of their hotels. Those hotels, they just collect franchise fees and royalty fees for having the Marriott banner. Most of those hotels that they own, guys, are owned by private investors, such as you and I, if we had the budget to actually acquire a hotel, and then Marriott or Hilton gives them guidelines to how they want the rooms to look, what kind of furniture you can have in there, how they want the lobbies to look like, what type of uniforms the employees should be wearing, right? So that's why their business models are a lot more resilient. They have a lot better net profit margins than Wynn, and Wynn obviously is beholden to only the 4 locations. That being said, I like the business, but be mindful of that, guys. It is somewhat of an inconsistent business model because of the exposure to China. So we have increasing EPS, which is very nice over the next couple of years, but not that much, right? It's increasing from this year, but not that much further. And revenue as well. It is increasing, guys, but it's increasing very, very, very slowly. So this is an example of a brand that I very frequently like to visit in Vegas. I like their hotels. I like the atmosphere in the hotels. I like the elegance of the properties. But then again, that's not a good enough investment thesis to be an investor in the stock right now. So be quite cautious with Wynn. We have a few price targets above, a lot of price targets above, as a matter of fact, but you can see here, it's about between the 113 and 140. So I would be mindful. If you are already in Wynn from the lows, congratulations, guys. But starting the position here kind of has equidistant risk to reward. And I'll explain what I mean by that, right? Well, our short-term profit targets has to be this big resistance here, past 4 or 5 years worth of resistance. So be mindful of that. We're coming up on a big one as well, around the 113. So the reason I say that this one is an equidistant trade, we'll take a look, right? If I take a swing trade from here, what is my profit target? My profit target is literally at that resistance area above, right? And where's my stop loss? My stop loss is below the most recent lows. It's literally a risk to reward of 0.8. Let's argue it's closer to 1, right? So you're risking 1 for 1. Not the best swing trade and not my opportunity. And for a long-term investment, I think there are more solid companies with more resilient business models, such as Hilton, such as Marriott, and if you want a travel operator, such as Booking.com, who also has extremely good profit margins and is a buyback king. So that's my thoughts on Wynn as a whole. Now moving on to Lovebox. Can I have your thoughts on Halo since their financial metrics look compelling? Yes, thank you very much. So let's take a look at Halo right now. So this one is a biotech stock, guys. We don't get to view a lot of these very often. And I would be lying if I told you that this is my area of expertise, right? I know some healthcare plays, but I do not know all of them. And biotechs often elude my scope, right? So it's not really my specialty as a whole, and I'll be forthcoming with that. That being said, we can do a very objective financial analysis of the company. So moving on, company valuation is about 6.71 billion. Let's have a look. Beautiful net profit margins right here, increasing net margins, crazy net margins for the last 5 quarters, anywhere between the mid 30s to high 40% range. Very solid, a check mark to the point for the bulls. In terms of their debt, not that much debt in terms of the revenue that they bring in, guys. This company brings in roughly $231 million of revenue. They have $1.5 billion in debt. I assume most of that is for research and development because it's a biotech stock. That's where most of their capital is going to go. And they do bring in a decent amount of free cash flow per year. So their balance sheet is not excellent, but it's not screaming a massive red flag at me. Taking a look at the EPS, beautiful EPS ramp curve, and obviously beautiful revenue ramp curve as well. So these two metrics are working wonders for the company. Analyst estimates are mostly either hold or price targets above the stock. So you do still have a little bit of appreciation. I did some very rudimentary fundamental analysis here. Gorgeous revenue ramp, gorgeous EPS ramp per year through 2027. Gives them a forward PE at the current price right now of 13 and only a 0.44 peg. Anything under 1 is fantastic. Between 1 and 2 is okay. And above 2 is starting to get a little bit expensive. So this one's looking very good, both on a fundamental basis and of course on a technical basis as well. The long-term bulls are in full control, beautiful monthly uptrend. And here is one of my favorite possible trade opportunities, guys. It is the legendary breakout of a large range, retest and possibly run. Healthcare and biotechs as a whole, guys, should be doing quite well. This is one of my sectors that I think might be an outperform if the risk on trade comes back. If we get through the fears of a recession and do not have a recession or either have a soft landing, the Russell's going to run. But one of the sectors that gets left behind a lot is biotech. And you can see when we get a risk on environment, guys, biotechs usually go crazy. So Halo here could be very decent for a swing trade. I do not know the risks to their business, guys. I do not know if the risks to their business are patent approvals, FDA lawsuits, things like that, everything that usually plagues biotech companies. But it is in a sector that is underperforming right now. And it is, one of the better names that I've seen in biotech as of recently. So if you're interested in this company, long-term investment, I couldn't really comment as a whole. It's just not a big enough company for me. And I do not think I don't probably think that they have that much of a competitive advantage. Thermo Fisher Scientific is one of the ones that I like having exposure to in the whole they have an aspect of biotech / pharmaceuticals as well. This is my favorite company for those types of plays for long-term growth. The market cap is extremely high. It's your market leader, right? But I think you have a decent opportunity here on Halo, or I have a decent opportunity here on Halo to make a swing trade because none of this is financial advice. So thanks very much for Lovebox to presenting us that trade. Now moving on to Tony C8547 asking us, great job, Will. Can you review Visa? Of course I can review Visa for you, Tony. No problem at all. So Visa. So Visa was one that I played after the big drop, after the renewed Department of Justice lawsuits headline came out. I love the Department of Justice. They give me the best buying opportunities of all time, most of the time, guys, right? Sometimes it takes a while, but give me more and more and more of those headlines, and I will buy those dips every single time, especially when the companies are operating as quasi-monopolies, right? So Visa is looking extremely strong. I think everybody knows the benefits of this company, right? Extremely high net margins, 53% net margins, absolutely crazy. Now, take a look at the debt. This balance sheet is an A+. Massive free cash flow per year and great amount of cash on the balance sheet. They do a lot of buybacks as well. A+ right there, A+ net margins. This is one that I own in my long-term portfolio, by the way. All of the analyst price targets, except for one guy down here, everybody is pretty much having a buy, over $300 buy rating right there. EPS, smooth, consistent, predictable. Revenue, smooth, consistent, predictable. Everything that I look for in a long-term company. I love Visa right now at 258. We did the valuation right here at 258. Now it's a little bit higher, but just keep in mind, the PEG ratio for Visa right now is not the best, but then again, it never really goes under 2 that much, guys, right? Even when it was down here at 258, it doesn't really dip under 2. Now that's a byproduct of a few things. Usually when EPS is close to 10%, the company is not so much known as a growth company anymore, so the PEG ratio doesn't provide the best insight. This is usually best for companies growing EPS at, mid to high teens. Think 14, 15%, all the way up to 20% and higher. The PEG ratio does wonders for understanding how much we're paying for a high growing company now, right? But what we do want to look at is the free cash flow yield of Visa, 3.63%. This is decent. So free cash flow yields, if you guys don't know what it is, it's basically your trailing 12 months of free cash flow. This right here, divided by your market cap. And it just gives us a good indication of how much of the company's free cash flow can they return as investments, can they return to shareholders such as us in the form of buybacks or dividend payouts. And usually for most companies, guys, most solid companies that have been in business for a very long time, you want to look for free cash flow yields as close as possible to 5%. The lowest I'm willing to accept is 2.5%. Obviously, the higher the better, right? So when companies' share price goes down, this number will get higher. And when the stock price runs away from us, the free cash flow yield number will get lower, right? So we want to find these on a dip. And at 3.63, it's pretty good. That being said, my preferred area for buying Visa was all the way down here, but it's not sure we're going to get that anymore. One thing's for sure, though, if you do revisit the 270, low 270s, I will be a buyer of this stock again. Technicals are looking beautiful, guys, at this point in time. Gorgeous monthly uptrend in full control by the bulls at this point, backtesting the 12 EMA on the monthly. The weekly is also looking good. Beautiful engulfing move by the weekly bulls, looking for the weekly higher low for possible further trend continuation. No problems for Visa. For this one, for a long-term investment, guys, I mean, it's in my own long-term portfolio, so take from that what you will. Not a recommendation for you guys, of course. And for a swing trade, the swing trade qualities do look quite good, but it's tough for me, right? Because I got this one down here. Tough for me to tell you to buy it up here, but in the event that the markets have more consolidation over the next few weeks, if we get bad earnings from companies, S&P, QQQs drop, if you can find Visa, guys, anything under 275, very, very decent for a longer duration swing trade, right? So looking fairly good in that respect. So thanks very much, Tony, for making us bring up Visa once again. Give me another quick second. And let's get into Shreya. So Shreya Bhat 8797 looking at, hey Will, great insights. Can you also analyze Cirrus logic on your next stream for a swing trade? It looks to me like it's forming a base and will pump soon. Yes, thank you very much. So let's look up Cirrus logic for a little bit of a swing trade. So not going to go over the fundamentals of this business too much, right? Because they mentioned that it was just for a swing trade. That being said, swing trade qualities not looking too bad, guys. It's looking like it's doing exactly one of my favorite patterns right here, which is also known as the infamous, right? The breakout retest. What are we looking to retest right now? Well, you can argue that there's this first line of the prior all-time highs right here. They backtested this once as well. Backtest of the 12 EMA is possibly underway. Now, what we're looking for here, guys, is if we want to do the top-down analysis, excuse me, the top of my nose is itching me for some reason. So if we want to move into the technicals of the company, right? What you're looking for on a monthly pullback. What is a monthly pullback? Usually it's synonymous with the weekly, the loss of a weekly uptrend, right? So we can see here, very, very, very strange price action. And usually that happens when the company's market caps are not that high, right? One thing we want to focus on though, is the company profitable? Yes, it's profitable. Is the company expanding EPS? The company is expanding EPS and the company is expanding revenue. Okay, perfect. The analyst price targets are above. So we know we have a little bit of wiggle room, right? It's not as if the stock just popped because it's a short squeeze and the company's fundamentals are terrible. So at least there is a bull case opportunity here. Now, that being said, what we want to be mindful of, guys, is considering the size of this weekly pullback, we need to know where we are on the daily, right? Where we are on the daily, the first thing that stands out to me, crossing of the MACD right now. We're under the moving averages, and this has been a long-standing daily downtrend, but now the momentum of the bears is starting to kind of flip positive as displayed by the MACD. So essentially what we're looking for here is the bottom of this weekly downswing. We want the weekly higher low for further trend continuation. And the way that we get confirmation for that is we need to see the daily uptrend confirmation. You need to see a break of 121 at this point. Low, high, higher low, and then we need the higher high for the daily uptrend confirmation. We take the trade on the break of the daily uptrend confirmation because then it allows us to set a stop loss right here. The problem if you take the trade without confirmation, guys, is if we buy it right here, yes, it's cheaper than if we wait for confirmation, right? But we don't have confirmation that the bulls have set the daily uptrend yet. So they could just roll you over and you'll just get stopped out. So if we take the break of confirmation, it allows us to put our stop loss down here. And then where are we targeting, guys? Well, this would be TP1. And then we zoom out to the weekly. TP2 would be your most recent highs. So that's how I'm looking at it for a swing trade myself. I need to see the daily uptrend confirmation. But what we're looking for is correct, right? We're looking for the monthly higher lows. Not quite coming back here. So that'll be the one thing, right? If the event that they break through this level and do not confirm and break lower, I'm pretty sure you know where they're going with it, right? They're probably coming back down here to roughly the 110 area. And then same analysis, right? Same analysis applies. If we get the breakdown there, you need to wait for the daily uptrend shift so you get confirmation that the daily's bottomed and that they're trying to make a run on the weekly and actually trying to make a run on the monthly as well. So those confirmations are the first ones that I look for whenever I'm looking for a swing trade in a company. So thanks very much for bringing those up. Now, moving on a little bit further here, did I close my, there's no way. I closed it, didn't I? My bad, guys. Let me just go back. I was on a roll there. Now they distracted me. Where's the, it's right here. Okay, close that one for somehow I closed it. So my bad, guys. So let's move on further here. So let's take a look. What were we at? We were at Shreyas. So Mark now, I'd love to hear your thoughts on Conoco Philips. So same thing for Mark as well, right? I'm pretty sure a lot of you guys that are asking me for these oil trades are trying to find the oil company that's going to stand to benefit the most from these runs, right? So you have a lot of company specific risk right here. I'm very, I'm very oriented towards either CVX or XOM because they are the market leaders and their long-term charts look like this, right? There's nothing particularly wrong with Conoco Philips. It's looking quite good. It has the exact same pattern as all the other oil charts out there. 2-year range of accumulation, and we're coming into the bottom end of that range of accumulation. The fundamentals of the company, guys, in line with the other oil companies we saw, right? Very good net margins between 15 and 20%. Decent free cash flow numbers, but a lot of debt because they have to do a lot of exploration. But the free cash flow is used to pay out dividends and buy back shares, which has an effect of artificially bolstering your EPS prices in the short term. All of the analyst price targets are above, and you can see very inconsistent EPS over time. It's not very smooth and consistent, and very inconsistent revenue curve as well, right? So this one is beholden once again to the price of the barrel of oil. We went through the list earlier, but all of these oil companies, for the most part, if they're solid, if they're not losing money or whatnot, all of their charts look exactly the same. So it's really up to you to determine which one is favorite for you. I personally have 2 favorites, and I've been over them before. I'm partial to the ones Warren Buffett is in. So I like CVX. I think they have the best balance sheet in the entire game. And I like OXY, for different reasons. But those 2 are my preferred plays. But as I said, once again, there's nothing wrong with Conoco Philips, but it depends why you want to play this company. Do you want to play the company specifically because you think that this company is doing something different in relation to its industry peers? Or are you just looking for a play on oil? If you're just looking for a play on oil and you want to remove company-specific risk, guys, well, you guys know the drill. I've already said it before. There's no shame in going with XLE, right? As the index as a whole, guys. You remove all company-specific risk, and if you think that oil companies are undervalued, what stands to argue, if they all run at the same time, the market weighting, the heaviest market weights in this one right now are XOM and CVX. But if you think the whole oil industry is due for a little bit of a pump, there's nothing wrong with going with the ETF as a whole, right? At least it prevents one thing from happening, right? Every other oil company has a nice run, except for the one that you chose, right? So that's just the fact of the matter. That's how I view oil companies at the current time. And long-term investment, guys, I don't hold any oil companies for the long term, but I do like making swing trades on them occasionally. I don't hold any in the long term, guys, simply because their business models and revenue streams are extremely unpredictable. Yes, and not consistent, right? They can have great years, but then they can have tons of years where they do absolutely nothing, right? So moving on to Ant, again, was an awesome trade. Oh, I got 2 in for Ant. Well, he's one of our Discord members, so I will do 2 for Ant. He gets the premium treatment, I suppose. I'm not trying to discriminate here, but he is in the Discord, so let's do that one for Ant. It was an awesome trading week, thanks to you, Will. No problem at all. Appreciate you saying that, and happy for your gains, brother. Would love to hear your thoughts on SJM for a swing trade. Solid financials, plus on the technicals, it may be ready for a breakout. Let's have a look at SJM, shall we? So, JM Smucker Company. So this is one that I have not seen in a while, and I've already outlaid a little bit of the technical aspect right here. As you can see, very long-standing consolidation range. As a matter of fact, 10 years. This is the monthly chart. This is 2014. 10 years, guys, coming into the 200 monthly moving average. You do not see those touch, often, but when they do, usually a decent proposition to go out there fishing. So, this company, 108, 110 would probably be your best bet at entry opportunity right now. In terms of the monthly, well, they're still trying to go through the reversal process. Let's take a look at the weekly chart right now. The weekly, not looking too bad. Trying to go for the breakout. Obviously, support level is right here. So you wouldn't want to lose this lower level right there. You just sacrifice the entire weekly move, and you'd be revisiting that big, massive green box that I drew on the monthly, right? So the weekly, not looking too bad, but I would keep a tight stop loss down here below about 112 because then you'd invalidate the actual run on the weekly. The daily, just simply, big consolidation range as well for SJM. And let's take a look at their fundamentals. Why has the company not moved in 10 years? Well, let's have a look. Let's have a look at their net margins. Net margins, not too bad right here, about 10%. But do I still have the... no, I must have closed it, right? But we can do this real quick. SJM profit margin history. I want to see if these are in line with the company's historical averages or if they're not. Let's go back to the past 14 years. Profit margins. So for profit margins, in line, recovery from the pandemic lows, right? In line with historical averages, operating as well, net margins as well. No crazy expansion there. So I guess it's business as usual for the company. In terms of their financials, well, this is a little bit of an issue, right? A little bit of an issue. So that is one thing for the company. They've significantly increased their debt load. I'm not too sure what that was for, whether it was for capital expansion or whether or not they had to kind of save a portion of their business, because we saw what happened after the supply chain constraints and COVID and stuff like that. They got hit really, really hard. So they possibly just borrowed some money that they were able to shore up the balance sheet, in other words, right? Now, moving into their fundamentals. EPS growth rate, it's a more mature company, so I'm not expecting to see crazy growth curves here. If anything, they're just maintaining. How much does this company make per year? About $8 billion in revenue. Their expectancy right now is about 8.9, so they're trading about a 1.1 price to sales, or slightly under, right? So that being said, on the monthly, not looking too bad, but this one is consumer discretionary facing, right? So yeah, there could be a little bit of swing trade right here, but we're not looking at a fast mover at all, right? So if I were to take the swing trade, I would keep a very tight stop loss, because we're looking for the breakout. It's not in a sector that's favored now. Overall, the fundamentals aren't fantastic. I see why you had it as an idea for the swing trade, but just keep in mind, it's not a very quick mover, right? It's not a very quick mover unless the company does something outstanding on its own to get a crazy price rally like this. You're probably just going to be waiting for the recovery of other consumer discretionary stocks as a whole. And in that industry, I do personally believe that there are some plays with some better risk to reward that might move a little bit faster for us in consumer discretionary. The one that I'm looking at closely right now is Elf Beauty, just because of their growth rates, right? And how much they've come down, and similar kind of setup, right? We're looking for the bottoming out of certain long-term timeframes right there. So that's just how I would view SJM. But thanks very much for proposing the ticker. Now, Miss Unique 65, ML, MoneyLion on the 12-month time frame, please. No problem at all. So on the 12-month time frame, let's take a look at the monthly, right? So not looking too bad. I'm pretty sure that Miss Unique meant the monthly, just looking on a year at a year prior, not the actual 12-month time frame, because then it would kind of look like this, right? But on the monthly, I mean, yeah. So essentially, probably what happened here is, the company had to do a little bit of share dilution, right? I don't see any. They do a reverse split here. They did do a reverse split, right? Let's take a look right here. 1 for 30. So it makes complete sense why the share price is high right there. So no problem about that. That's not too big of a factor, guys. Share splits do not impact the valuation of a company whatsoever. Now, in terms of where they currently stand, right? So MoneyLion, if you guys don't know what MoneyLion do, super interesting company, right? So they are a fintech play. They do a ton of different things. They do cash transfers, borrowing, banking, credit building, investing. They have a ton of great resources on their platforms, guys. They have a lot of knowledge that they put on their platform as well. Let me just scroll down and see if I can give you guys a glimpse. It wasn't on this page. But yeah, you can see they do a bunch of different things. Classic fintech company. You can relate them kind of to like a Square or a SoFi, but they do have certain niche things that other companies don't have, such as their learning features that they have on the platform. Very, very nice. I haven't used it myself personally, but I've seen a bunch of other people use it, and I've watched a lot of content on this company in the past. That being said, the one thing you want to keep an eye out for MoneyLion is the fact that they're a very small company for now, right? So take a look at the market cap right now, about 457 million. So it is a high growth company, or a fast growing company. Net margins are now coming towards profitable. This is annual. Look at quarterly. The past 2 quarters, they are now net margin profitable. And that is very, very, very good for if you're looking at a fast growing tech company to be now net margin profitable. Finally, finally free cash flow positive as well. That is very, very good. That's what I like to see when you're looking for some of these companies that have been beaten down because of the environment that we're in right now. We know growth companies have not been getting a lot of love from Wall Street, especially the unprofitable ones in a high rate environment. The fact that they're now profitable, rounding the corner while still growing their business at the same time is very, very good. You have a recipe of confluence, and I like to see these things. All the analyst price targets are significantly above the current share price, coming into positive EPS territory. We can't derive any PE ratios right now or forward peg growth rates because we're coming from negative to positive, right? So we need to wait until 2024 ends for that data to make a little bit more sense. Revenue expansion, very, very healthy, guys. And what I love about this company right now, the valuation that we can do when EPS is negative is what's known as a price to sales. How much is their market cap in relation to the sales that they bring in? And as you can see right here for 2024 on a forward basis, they're actually below a 1 price to sales. If you divide their market cap right here for, 457 divided by their future revenue, 529, they're trading at a 0.86 price to sales. A lot of these tech companies, guys, in a growth favorable market like we were a couple of years back, right? It's coming back. Don't worry, it is coming back. sometimes these companies, especially these tech companies, guys, they'll trade at 10 price to sales, 10 price to sales is not unseen, which is where they were up there, right? They'll trade at 5 to 10. So finding this company under a 1 price to sales is extremely, extremely good in my opinion. Now, I have their earnings slides in front of me because one thing that I want to know is even though they are growing, their revenue very, very well right here. Let me see if they give a breakdown of the curve. Yeah. So even though they show the revenue expansion, right? I want to know, are they charging people more money or is it actually their consumer base that is growing? And as you can see, guys, extremely healthy consumer metrics right here. 17 million customers use the service as of right now. Very, very, very good. Marketplace is driving the majority of their consumption growth, which is very, very, very solid, guys. They're great at matching specific products to their different clients in terms of whether you want a loan or stuff like that, right? All their insurance, all their products are down here. They have insurance, high yield savings, credit cards, home loans, business loans, auto loans, education loans, tons of different things, banking, investing as well, manage a stock portfolio, right? Tons of different offerings, classic fintech play. I like the valuation. They're growing their customer base extremely well. And I liked what I saw through the earnings right there. We can also see their net margins. Because the company's not profitable, I want to know, what are their actual gross margins? Gross margins are revenue minus cost of goods sold. No marketing expenses, no stock-based compensation for management, none of the excess expenses, right? I just want to know, is their platform generating good margins versus what it costs for them to run the actual platform, right? Pure cost analysis, none of the extra cost fluff, right? Because we know that cost fluff will eventually disappear. Healthy gross margins up here, 70+%. That is what I want to see in a fintech company, guys. 70, 80% plus net margins, because when they scale the revenue, guys, the other miscellaneous expenses that are making operating margins negative or slightly positive, those will all get eventually absorbed and they'll be able to generate more and more profit. You've seen that with the way PayPal scaled. You've seen it with the way Square scaled, the way SoFi scaled. They all have the same scaling curves. Eventually, as long as your gross margins are good, the rest of the business should indeed follow. So I like this one. Valuation is cheap. At this point in time, the technicals are obviously a little bit, a little bit overdone to the downside, in my humble opinion right now, right? So right now we're just looking. Unfortunately, we lost the monthly higher lows right here. Unfortunate, but we're very, very, very close right now. I wouldn't be paying too much attention to the short-term technicals because this company is so cheap right now that any large sales in either direction, right, or earnings or sentiment in the market is going to make this one fluctuate a lot, right? But if you believe in this company, in my humble opinion, the valuation alone would support a little bit of a bid. Now, would I be going all in on this company? Probably not, but I would not be opposed, even for myself, if I was interested in buying this one, to start a little bit of a feeler position down here. And if it comes down into our lower end of support, let's say, the markets just fall apart and growth stocks just get battered again, and we come back down to 30, decent, because it won't be this company's fault specifically. As we just saw, all the metrics of the company are actually growing quite well. So even on a 12-month basis, right, we're trying to form a base. You can look at the 6-month chart. It'll probably paint a prettier picture of what they're trying to do, right? We're trying to set longer-term monthly higher lows for further trend continuation, but as of right now, we have no short-term time frame control, right? If you're looking for the actual confirmation, well, that would come first by setting the daily uptrend, get the daily uptrend in motion, then give me also the weekly uptrend too. I need to see a bounce here, maybe into the 50s, touch the moving averages, higher low, and then weekly uptrend confirmation. Then you'll probably be sure that the monthly lows are set and looking for some possible expansion too, right? So this is a nice play right now, decent valuation. The stock's cheap, but not one that I'd be betting the absolute farm on. I wouldn't be going, super, super heavy in my portfolio, but could be one that you just buy with a, maybe 1, 2, 3 year time horizon and just let the company grow into scale, right? And I would not be surprised if it can actually retest when the growth stock favor comes back. Wouldn't even be surprised, guys, if this one could 2, maybe even 3x, because the valuation does support expanding those multiples. It's really, really cheap right now. So thanks very much for that one, Miss Unique. Now, Monty coming in at the end here. Fabulous stuff. Can I request Vertiv Holdings? They've been on a run. Yes, absolutely. We're going to wrap it up with VRT. And before we do VRT, give me another quick second, guys. And let's get right into it. So this one offering, data center plays, right? Classic, right? So this one, before the NVIDIA effect, was doing absolutely nothing, right? So now that we have the data center ramp, a lot of these companies are coming alive and a lot of people are also chasing, right? So if you're in early, I maintain the same thing. This goes for Vertiv. This goes for, the one we looked at earlier, Celestica. This even goes for a lot of the nuclear energy plays, right? Constellation Energy, stuff like that, right? If you are in from prior levels, perfect. You are in. But starting a position here, guys, is extremely tight, extremely risky in my opinion, guys. The risk reward is just not there for the longevity of the company, right? If the industry slows down, more competitors enter the market, or Nvidia and AMD start doing a lot of these things themselves, well, these ones are going to fall off a cliff, right? So this one offers, for the most part, they offer power supply management solutions, cooling solutions for all the server racks that you have in data centers. So of course, their business has been ramping through the absolute roof. You can see that very clearly as we look to their EPS ramp. They were doing nothing before 2023, and now boom, complete ramp up. Revenue, same thing, but look at the analyst price targets, right? We're coming into full value. Even though everybody is a strong buy, nobody has price targets exceeding 125. So we're coming into fair value for Vertiv. Most of the strong buys are probably reiterated down here, which is where we looked at the stock the last time that I was asked for this one by a subscriber, right? We looked at it back here. And as a matter of fact, I gave the valuation at 85 and said the valuation at 85 or anything less could be a decent little opportunity to pick the monthly higher lows for possible further trend continuation. And I was telling you guys to watch for eventually, because we were in a big downtrend, right? I was telling you guys to watch for the recapture of the weekly uptrend, and then you'll have confirmation. You can set the stop losses and go for the absolute maximum all-time highs on the monthly recapture, the monthly upswing. So this is another one, guys, that I maintain, right? If you are in from lower levels, this one for me is a hold, right? Because we are in a bullish environment for these things right now, but I would be scaling out, right? If you're in, you just hit a take profit level right here, the prior all-time highs. I would be scaling out of these positions. At best for me, they remain swing trades. That being said, the PEG ratio is not too bad at a 1.58. They are scaling. I'd just be nervous as to how long can they keep doing this in the future. Once the infrastructure build out is complete, this company's probably not going to do that much, right? So demand is through the roof for their products right now, but that demand eventually, the velocity of the demand is eventually going to taper off, right? So that's just how I view Vertiv Holdings. If you're in from prior or in from all the way back here, taking profits has never hurt anybody. Scaling out progressively scaling out. If you're in from back here, progressively scale out as the levels are hit and stuff like that, right? So that's just the way I view it. But opening a position right here, guys, the risk reward is non-existent in my opinion, right? Yes, can they move higher? Sure, they can move higher, guys, right? But you're coming into pretty much full valuation right now. The company generates revenue of about $7 billion. The company's currently trading right now at, let's have a look at their expansion, right? 10 billion by 2027. So the company can expand possibly, 50, maybe even $60 billion in an extremely bullish market, maybe up to like the 130, 140. But that's lofty expectations for the company, right? So just don't forget to scale out, take profits when you find it necessary, right? So because I'm pretty sure that most of you guys are invested in this for the swing trade, for the AI trade, for the infrastructure build out trade, right? Pretty sure none of you guys are going to hold this company for the next 15 to 20 years. So be diligent with your profit taking, because you guys always know that when we have tremendous momentum to the upside, we are presented oftentimes with some very good dip buying opportunities. So don't think this one's going to run away from you forever. Eventually it will have a weekly form pullback, and then you can re-enter, rescale into some positions and obtain possible better pricing. So that was pretty much everything, guys. I really appreciate all the tickers that you sent me. It's been a pleasure doing this one again. I really love doing these videos because of the fact that, as I said, right, I know a lot of stocks in the market, but I don't know all of them. So it's always refreshing to get your guys' ideas and give you a little bit of my input as to how I would view them for either a swing trade or a long-term investment. So always a pleasure, guys. Now, if you enjoyed today's video, consider dropping a like. Would really appreciate it for the growth of the channel. Also consider subscribing if you're new. We do these subscriber request video, guys, every 2 weeks roughly, just to give some time for the tickers to pile up in the comments. And if you asked me a question for a ticker in the comments and it was not featured on the video, guys, it's probably because I answered your comment. If you ask me for my opinion or my thoughts, stuff like that, sometimes I'll just give them in the actual comment section, right? So be sure to check the replies to your comment, because I've answered everybody who's ever asked me for a ticker. I've either done them in the video or answered you directly in the comment section. And if you would like to have your ticker featured in one of these videos, guys, Well, you know the drill. Leave me a comment down below in this video or either one of my videos that I do Monday through Friday after the close, or daily market recaps. So take care, guys. Have a great rest of your weekend. I'll see you tomorrow for the top 5 options plays of the upcoming week videos. Take care, guys, and peace.